Now I have the pleasure of introducing Chris Finefrock. He's the Senior Vice President of Financial Planning and Investments. Chris has created one of Valmark's most innovative enterprises for members. He oversees what I would describe as a dream team of specialists who do the design and implementation of all various elements of our comprehensive plans. Our firm has had the pleasure of working with Chris since he first joined Valmark as an intern. He has a master's degree in financial planning. He's a favorite member Speaker Summit, and he's also presented at AALU, and he's authored numerous industry articles. Please join me in welcoming Chris Finefrock. Chris?
Wow, this is a pretty awesome setup. Well, thanks for coming this afternoon. Hopefully everybody got their fill, and hopefully no one falls asleep on these comfortable couches we got here. So it's been about 12 years, actually, since we started the financial planning team. I joined about 15 years ago, and I had the opportunity to join Caleb Callahan when he went over and kind of took over the annuity division. We had Tyler Denholm, Caleb Nitz, Mike Chisnell, Michael McClary. We kind of all sat together and we just pretty much talked about the individual products that we represented. And around that time, we started to have this convergence of, hey, how does this plan to like Social Security and these annuities and these TOPS programs, and like how does all of this basically come to a head? And I was kind of like the nerdy math guy that liked spreadsheets with Tyler, and we started kind of modeling some things out while Caleb Callahan and Mike Chisnell basically came up with like the marketing story around risk. And so that was kind of like how this all started. And now we're 12 years later, and we start talking about these income allocations. That was basically the premise of our entire financial planning system, was really the whole transition from asset allocation, just accumulating wealth, to income allocation when your paycheck stops, when you go to retire and you actually start living off those assets. So what we're going to talk about today is a lot of, hey, why did we set things up? And we set up a lot of things, 10 to 15 years ago, and now really looking at them again after over a decade has passed, and what should we be doing differently or thinking differently about, given the environment we're in today, the economy that we have today, the interest environment that we have today, and how has things changed. So the first thing I want to do is just lead off with like my definition of financial planning, which I consider an art more than a science, because there's not a scientific reason for doing one thing over the other. It's all preference. It's more qualitative about the client relationship and what their fears are and what their aspirations are throughout their retirement. And so I really think it is an art of continuously rebalancing and reprioritizing an infinite number of variables with a finite number of resources, okay? And those variables change over time, and that's kind of what we're going to talk about today. In this version of kind of the regulatory environment that we're in, where everything is now on a fiduciary landscape, we also have annuities coming to the forefront. A lot of, when we started building risk and ARC and all of that, it was kind of like, how do annuities really fit into this as far as base income, and how do you model that? And so instead of giving you like my definition, I really think one of my idols came up with a better definition of how to assess annuities within a fiduciary financial plan, and that's my boy Kenny Rogers. So when Kenny Rogers, he says, you got to know when to hold them, know when to fold them, know when to walk away, and know when to run, okay? That's kind of how I feel about annuities, and especially over time as they're in the financial plan, you got to say, hey, when are they still really good to hold? When do we need to fold them? And then for some of them that we see in the market, we really want to help our clients run away from some of those as fast as they can, okay? So whenever I look at any sort of risk-based solution, right, I always consider like, hey, when you're considering insurance, and a lot of these income riders that we talked about 12 years ago, it's just a form of insurance. You look at like, hey, what is the insurance versus what is the desired outcome, right? For homeowners insurance, for auto insurance, for term life insurance, you look at like, hey, the catastrophic risk I'm hedging against is fire, theft, me hitting something with my car or something hitting me or dying early. Obviously, the desired outcome is I don't have one of those events occur, okay? With income riders, it's always just a little bit strange, but it should be considered the same thing, where I don't want to outlive my money, okay, and I don't. So, but the harder question about that is, when is the right time to basically not have that income insurance anymore, right? Like Lincoln, Nationwide, all of them aren't calling us up and saying like, hey, your client has an income rider and they might not need this anymore. They just continue to charge that income insurance cost even though your clients may never get any value for it. So what we really need to do is basically go back through and look at all of those things, okay? So we're going to do that today, and I just want to look at the collective expertise in this room, okay? So when I love getting into the data, right? We like comb through and mine all the data, and so this room represents about $4 billion of annuities under care, okay? We have about 19,000 contracts collectively, okay? That represents over 50 companies, 1,000 products, and over 5,000 riders and benefits. It's a lot to keep track of, okay? That's some of like the specialty of having like Zach and Michael. We have a database that represents these products, and we can kind of figure out, hey, what version is this? How does this thing actually work? What does this thing actually cost? Like, how is that? So that's kind of where we come in and we try to help kind of carry that load. But this is kind of where we're at. This is what this room represents, okay? And when we looked at like, hey, when we put these in place 12 years ago, it was really a point in time assessment where we were helping all those clients that were reaching the top of that retirement mountain, and they were right in this period of retirement ramp up and retirement red zone, and they were really the primary concern of like 99% of the risk plans that came in was sequence of returns, market risk, and longevity, like those three things. So yes, we implemented a lot of annuities back then, and a lot of them are still in our books. When we kind of comb through that data over 10 years, between 2011 and 2015, we issued 5,600 contracts and over $1 billion worth of annuities to hedge primarily against that risk. The average age of the client that we implemented those annuities on was age 62 at the time, okay? And if you remember the transition from asset allocation to income allocation, the whole premise was this, and I circled the ones where these annuities were put in place because of the unaddressed risk on the far left-hand side. That may be a perfectly well-diversified asset allocation portfolio inside of a 401k or an IRA, but it does not systematically hedge against some of the risk associated with retiring in those early years, most notably the longevity, market, and sequence of returns risk, okay? And it's good planning when we actually look back and we say like, hey, why did we do all of this and did it make sense? We can say yes. We did a lot of presentations throughout the last decade of member summits that kind of proved, hey, why is this so important? And we could have basically just had this slide, because I think this slide summarizes it really, really well. When you look at this slide, it looks at someone's working years, and then it looks at someone's retirement years. And it's modeling the importance of basically the impact of having a negative market sequence of returns risk in a given year of both pre and post-retirement, okay? And what you can see is this giant spike, okay? This giant spike in the middle is right at retirement. Those 3 years plus or minus retiring are the most important years that would really impact a client if they had a negative market sequence of returns risk. So this is exactly when we implemented most of those annuities, okay? Good planning, because it was the time in which if we had a really bad market cycle, we needed it. Second to that, it was good planning from a longevity perspective, right? That second risk that I talked about was, hey, if there is longevity, we want something that's basically going to last as long as we do. So when we look at these living benefit riders, you can see here, I've got the bell curve of life expectancy, and you can see the probability of someone living to various different ages. And then in gold, that's actually life expectancy. And if you looked at when we placed these solutions and when they'd actually run out of money at a 0% rate of return, it's well before life expectancy. So you can say like, hey, if the market is earning zero, which it was back then, we had like 0% interest rates, and they just spent down their own money, then basically they'll continue to live off the insurance carrier's money for a number of years well past life expectancy, okay? So good planning, 62-year-olds, market sequence returns risk, right when they were having that biggest risk, we implemented these solutions. Right when they were getting ready to head into retirement, we were in a 0% interest rate environment. Their probability, if they start spending down these things, they'll run out of money, and the income insurance was absolutely a key piece of their financial plan. So flashback to 2010, the original risk presentation. So I can't take any of the credit for these slides. This was probably Michael Chisnell or Callahan that built these slides way back when. But I still think this kind of represents why sequence of returns is such a big issue. So if you have $1 million client with a 60-year-old client with $1 million and they need to take $50,000 off a year with a 3.5% inflation, and you have a 7% market rate of return every single year, that will basically go till they're age 97. Okay? Now, whenever you talk about sequence of returns, when you're talking about average return, it doesn't really matter. But you can have that same 7% average rate of return, but you plug in a different market sequence of a +7, +27, -13, so it still averages 7. But as you're distributing money and you're taking money off of that, when you're selling when the market is low, right, in that -13, it significantly cuts down on the longevity of that portfolio, right? So you just accelerated how fast you run out of money by 6 years, okay? Then the last piece of this is, okay, well, instead of it going 7, 27, -13, well, if it went -13, 27, 7, this is like the early, hey, right when you actually start to distribute from the money, what happens then? Well, at that point, instead of running out at age 97, you run out at age 86. So that sequence of returns risk has an 11-year impact on the sustainability of that portfolio. That is a huge risk, and that's why we implement some of the solutions that we do for people in that retirement red zone. It still is a very applicable and very good planning for someone that is nearing retirement. So back to present times, I'm still talking about the solutions that we implemented 10 to 12 years ago. When we look at a chart like this and we say what actually happened, okay, remember their biggest risk was circled over here on the far left, right? Their biggest risk was I'm retiring and I can't have a big market sequence right when I retire because that's when it's catastrophic to my plan, okay? But what happened? It wasn't a complete uphill, like, really smooth ride, but for the most part, the market has been pretty good. I mean, no one predicted in 2009 to 2015 that we'd have a pretty smooth upward market where we didn't have a sequence of returns event, we didn't really have inflationary risk, we didn't really have all of those different things but that we planned for. And that's not a bad thing, right? Like, did anybody like call their State Farm agent and was really upset with them last year because their house didn't burn down? Like, you shouldn't be upset about this because you hedged against a risk and that risk did not occur, okay? But you're still paying insurance in order to protect against that risk. So I think that's one of the most important things is like, hey, understand that it was really, really good planning. But we just didn't have the risk that we were hedging against. So when I fast forward to today and I say, hey, where are we now? I said, hey, when we issued these contracts, we're at age 62, average client. That same client now still holds that annuity. They're 73. And a lot of them have been distributing money off of these annuities, okay, because they're leveraging the income benefits that are on them. So their current account value is about $178,000, okay? And their benefit base is $234,000, okay? So it's a leveraged benefit base when I look at that. The average payout, okay, I know someone's going to stand up and say, I have someone with a 7% GMIB. The average payout is a 5%. Okay, with an income rider cost of 1.1%. So when I say 50%, this is the average. That means 50% are better and 50% are worse. So you may have spreads that are a little bit different. You may have rider costs that are a little bit higher. You may have clients that are older than this. But on average, of that $1 billion of account values in those 5,600 contracts, this is the average scenario. So now we look 10 years later and I plot on the same chart. What does sequence of returns look like for a 73-year-old? Okay. As we go through retirement, sequence of returns risk doesn't go away, but it does significantly diminish. And why is that? Well, I'm getting older. I don't have as long of a time horizon. So if I do have a negative market sequence, like, I don't really need as much back to get me back to even because I don't really have as long before, I obviously will pass away. So from that standpoint, it still exists, but is not as prevalent and it is not as important as it was back between age 62 and 65. From a longevity standpoint, the actual bell curve of the life expectancy actually becomes a lot more normal. When you're 62, it's kind of like a negative skew where the mean is to the right of the mean is to the right of the median. this becomes more of a normalized bell curve, so you don't have like the mean significantly higher, as well as you can see that the average time it takes for the client to actually spend down their own money at a 0% rate of return and their life expectancy is almost equivalent, which means half the clients are probably never going to spend down their money. Okay, so things have changed, and we've been leveraging these products appropriately, but because of the market sequence that we've had, we basically are now living in this environment. The next step of that is people's priorities are changing, right? You move from the retirement ramp up to the retirement red zone, and now you're somewhere between the retirement red zone and the wealth transfer phase. So people are starting to think differently about their wealth and their aspirations and things like that. You know, some people call it like the go-go, the slow-go, the no-go years. Like, people are leaving the go-go years and entering that slow-go kind of phase, and they're thinking about all of these things, and we're helping them evaluate the cost and benefits of all the solutions that they put in place 10 to 15 years ago. So what do we do now? Well, we're going to do what we always do. We're going to create a module where we try to simplify everything to have a 10-minute conversation so the client can really evaluate what are all these things that the annuity carrier puts on the statement. What does it actually mean from a cost-benefit analysis, and how do I actually make an educated decision on whether or not this is a good thing or a bad thing for me? At this point in time, I can explain that it was a good thing for me to have 10 to 15 years ago, okay? So the income rider evaluation, we're big on acronyms. IRA was already taken, so we came up with the IRE, and so this is kind of the premise of trying to boil it down for in-force annuity contracts. What does all the jargon mean on the statement? How are the actual costs and benefits calculated? And then comparing it to different rates of return, how long will it take me to exhaust my own money? Because that's the ultimate question of income insurance, right? The ultimate question of income insurance is, when does my money run out and I start to live off the insurance carrier's money? Because if I never get into the insurance carrier's pocket, all I'm doing is funding the insurance executive's retirement plan. Like, it's a bad deal for me, okay? So we have to be thinking about, how do I spend these assets down? It's the most important thing when you're considering annuities, is to actually get these things spent down. So bring back my boy Kenny Rogers one more time. We got to know when to hold them, because a lot of these are good contracts. I said, hey, half of these, 50% of these are better, and 50% of these are worse than the average. So we got to know when to hold them, and we're going to talk about those. And then we got to know some of them that may not make any sense anymore, given the market and where our clients are at on their retirement journey. So bringing our cards in hand, got the ace on top, assessing our cards in hand, okay? The first thing is, almost all of these contracts are variable, okay? And it's some of the reason that we can have this conversation, because we've been drawing off of them for the past 15 years, and they've kept up, relatively speaking, to the benefit base, right? If these were fixed solutions that we were taking 10 years of distributions off of, they'd be almost out of money by now, okay? But because these were variable contracts and that they were getting some participation in the market, they are still relatively close to the benefit base. So when we look at these things, we got to do one thing and say the market upside is not likely. When you're actually spending the income guarantee of these solutions, the market is not going to catch back up on the average case, and you're not going to get a market step up and actually get an increase in income. And why is that? Well, there's 4 elements that you have to overcome, as well as the spread between the benefit base and the account value, in order to actually make that happen. So in our average case, when we look at the mortality and expense charge, the rider cost, the fund charges, and the guaranteed income withdrawal I'm taking, it's almost $18,000 of drag on my $178,000 portfolio, or 10.33%. In addition to that, I said our account value is $178,000, and our benefit beta is $234,000. So annualized, I have to make up 32% of market gain to catch up with my benefit base, and I have to overcome the 10.33% hurdle rate that I'm withdrawing from this contract every year in the form of withdrawals and fees. So in the average solution, it's not going to happen. So when I look at my hand, I basically have to look at that income stream as if it's never going to get any better, right? I'm only going to get that guaranteed income stream on the average case. The second component of this is, some of the fees aren't static. Some of them actually are rising, okay? And I think this is one of the things that I think we don't talk about enough is, A lot of the benefit bases, now this isn't all carriers, but it's most of them, okay? Most of the benefit bases, the cost is actually based on the benefit base, not on the account value, okay? So when I get my statement and I like celebrate that my benefit base went up this year, it's like celebrating that your cable bill went up and you're actually getting less programming from your cable company, okay? It's not a good thing, okay? Because you're actually paying more as your benefit base continues to ratchet and goes up and up and up. So in our case today, we have a 1.1% cost on the benefit base, which is about $2,500, which is actually a 1.45% cost on our contract value, which is actually the amount that the client is paying, okay? Now, as we take withdrawals and this account value gets spent down to $100,000, it's actually going to be more like a 2.5% drag, okay? So even beyond that, the benefit base, the account value is way higher than the benefit base, or excuse me, said that backwards. The benefit base is way higher than the account value. We also have to overcome the fact that as we take more money out of this contract, it actually gets more expensive instead of less, okay? So further saying, we're never going to get any better than that guaranteed income stream coming out of that contract. So the analysis, the evaluation part that we like to do, we like to say, hey, how long does it take to spend my own money, and is the cost actually worth it? And so at the bottom of the IRE, and this is the most important point, is it basically says, I'm not likely to get more than my guaranteed income stream, right, number one, and I know I can walk away with my account value today. So my $11,700 guaranteed payment based on my rider and my $178,000 account value, if I was to take that out and invest it somewhere else, how long would that income stream last? So let's look at that top one, 0% rate of return. So I just cash out my annuity, put $178,000 under my mattress. I'm 73 years old. How long will that last me, right? It'll last me until I'm 88. That's basically life expectancy. We went through that a couple slides ago, okay? So worst case scenario, I basically have the same cash flow without the annuity to my life expectancy or 50th percentile. Now we start looking at, we're in a very different interest rate environment. So I'm leaving a guaranteed annuity, right, where I can get this $11,000 guaranteed. So how probable or how likely am I to get a 2 or 4 or 6% rate of return in a different solution now? Well, pretty likely. We have 5 and 7 and 10-year fixed annuities paying almost 6% at this point. So we're in a very different interest rate environment. When you basically say, hey, I'm going to take money out and put it in a net rate of return at 2, 4, or 6%, look at how much longer the client has to live in order to actually spend their own money. So we just have to look at this thing a little bit differently. Charted differently, this is the exact same thing that the evaluation shows. It just plots it a little bit differently. So again, on an earlier slide, I said, hey, at a 0% rate of return, it's basically life expectancy, 50th percentile there, okay? At a 2%, 4%, and 6%, you can see the probability of survival as well as, you know, how long you'd have to live in order to spend your own money down, okay? So that's where we're at. So the next thing is know where to hold them, okay? So that's kind of the cards we have. This is know when to hold them. We ran an IRE on a client, and it looked something like this. They were 64 years old. They bought the annuity maybe someone consider a little earlier in their 50s. It was guaranteeing $14,000 a year, $125,000 account value. This thing's going to run out in the client's mid-70s. Like, that's an awesome deal, right? Like, 10, 15 years before life expectancy, they're going to be living off the insurance carrier's money. Trust me, the insurance carriers do not want them to start using this annuity. But this is absolutely in the client's best interest to start drawing and run this thing out of money and basically treat it as a pension, okay? So what other clients are we looking at that's like absolutely hold them? Clients that are super bearish, okay? They are completely risk averse. They're basically the person that would like, hey, unless I'm going to cash this out and put it under my mattress, I'm staying in the guaranteed product, okay? Ones with higher withdrawal bands. So we can run this IRE if you have that 7% GMIB out there. We can run it and basically figure this out. And if nothing else in this fiduciary annuity best interest, it's like proving that this is the best thing for the client, okay? If it's a higher benefit base versus account value, so some of you have some solutions that maybe the market performance didn't perform as well as you'd like to, so the benefit base is significantly higher. Those are the contracts, and then obviously the younger the client is, right? So if you have a client like this one that was only 64, they're in a much better spot, and those are going to be the ones that we look at, and it's like, hey, these are the 50% that it's definitely going to be probably a hold recommendation. But not just a hold, it's a hold and leverages that income rider. I got to be careful saying this, but probably like 90% of the time, if the client's older than age 65 and doesn't have their rider on, they're not leveraging it properly. If you just look at longevity curves and how that works, like the highest probability of actually leveraging the contract and getting into the insurance carrier's pocket is age 65. If you don't need the income age 65, consider using it as partial transfers to an IRA or partial 1035s, but don't not take the income, because the best thing you can do for the insurance carriers is have income insurance and not actually take income. That's the best thing for the insurance carriers, okay? And I know there's a mental hurdle to get over with a lot of clients because they can't separate a benefit base, which has no value if they pass away with money in the contract, and the account value. Okay, I know that's a hurdle. So, but these are the clients that we would hold, okay? So knowing when to walk away and run, okay? The client doesn't need systematic income or believe they can earn a higher net rate of return. Some alternatives to consider is some accumulation solutions, some cash flow solutions, some estate and generational planning, some higher guaranteed lifetime income, okay? I'm going to get into like some scenarios where it's like, hey, maybe they have an income rider, but they actually just want more income, and they can get it in today's market. And then the last one is obviously long-term care. So now we're going to get into what to do with the 50 percentile of solutions that may not make any sense given what we've had in the market. So let's look at these. For managed accounts, obviously if it's a qualified registration, you can go anywhere you want as long as the client's willing to take on a little bit of risk, right? The guaranteed income goes away. But you have 100% liquidity, same thing with mutual funds, same thing with the advisory annuities, okay? They're 100% liquid. The other things are like the BD IOVAs, and then what we were talking about a little bit earlier is the RILAs, the fixed index annuities, and the fixed deferred annuities. Obviously, there's a little bit less liquidity here, but when you're looking at trying to replicate kind of like the guarantees, and you look at like a fixed deferred annuity paying almost 6%, or some of the RILAs with the protection that they have, you can kind of dial in like what rate of return are we trying to actually accomplish here over the long run to basically replicate the same income stream that we're not really giving up a whole lot from leaving the income insurance. You know, one thing that's fascinating to me is like how much these can resonate with some clients is just plotting the accumulated costs over time. So looking at the divergence in value, and it's just like, hey, Albert Einstein with his ninth wonder of the world of compound interest. That's all it is. But you just look at the drag of some of these riders and things on the account value over time, especially for clients that aren't spending the annuity because they don't want to turn on the income for whatever reason. You probably shouldn't have that income guarantee because look at the divergence in account value when you go out 10 to 20 years. And they plot, like this is one of Nationwide's outputs. I can't take any credit for this, but they just basically plot the differences side by side. So maximizing lifetime income, a lot of you are going to say like, hey, my client like really loves the guarantees of the income, and even though it's not probable, they just like that periodic paycheck to come in every year. So I would say like in this interest rate environment, you should probably be looking to say, hey, if I have $178,000 of account value, that's giving me $11,700 of guaranteed income. With interest rates being where they are, SPIA rates have come back phenomenally, okay? So if I look at a 73-year-old male on a cash refund, we would get about $15,000 or 31% increase in income, okay? The female is about 23% income, and a joint and survivor 100%. So a lot of those annuities are single life. Joint and survivor, you could basically move and get a 16% pay bump for the rest of your life. Again, accelerating how fast you're getting into the insurance carrier's pocket. So better deal than maybe what they have today. Okay? When we're looking at consumption, whenever I consider annuities, and I have this conversation quite often, it's like qualified accounts and non-qualified annuities are not the best wealth transfer vehicles, right? Like the next generation is going to have to pay taxes. You don't get the step-to-basis that you do with a taxable account. So a lot of times we're trying to figure out is how do we unwind annuities and qualified accounts in a very tax-efficient manner and basically leave the Roth accounts and the taxable assets for emergencies and for generational planning to get step to basis, okay? That's good planning. I know it's kind of like it's a sliding scale on how you do it. And one of the main ways that we do it is something that we call bracket topping, okay? Where we basically are trying to take advantage of those low or tax brackets and the standard deduction in order to spend down annuities, okay, or spend down IRAs so that the effective tax rate is very, very low for the client, okay? So when we just look at this for a joint household filing, if you look at the first $117,150, the effective tax rate is 8.78%. So you got the standard deduction, the first $27,000 isn't taxed at all. Then you got the next $22,000 taxed at 10%, and then the next $70,000 taxed at 12%. That is super cheap money. Whenever I hear these like people that say you need 100% of your money in Roth IRAs, I'm like, no, you don't. You actually want your like first 100,000 plus coming out of ordinary income because it's super cheap, right? It's super cheap. You don't want to have all your money, like you don't want to convert everything to a Roth IRA and pay 37% taxes, then to have 0% tax where you'd have 0% tax anyways because you're under the standard deduction. So like good planning is figuring out how do we structure cash flow in order to maximize some of these lower brackets. So, oh, there's a weird. Anyways, let me give you a case scenario over here on kind of how we do this in practice. So let's just consider our average client is that 73-year-old married couple. They have $2 million of total assets, $500,000 in IRAs. They have $1.2 million in non-qualified assets. Then they have this $250,000 annuity, and maybe it has $150,000 of basis because it's non-qualified. So from a lifestyle need, they need about $130,000 a year. From Social Security, between the income earning spouse and spousal benefits, they're getting about $50,000, okay, of which they're maxing out, and 85% of that is taxable, so $42,500 will be part of their taxable income. They have a required minimum distribution. Let's just assume at 73 it's roughly around 5%, so they got to take $25,000 out of their IRA. And then let's figure out a plan for that annuity that we've just realized we might no longer need just because of the cost and benefit analysis. Well, what if we could invest that taxable portfolio in the IRA to not have to generate cash flow for the next 5 years that even more substantially mutes the sequence of returns event that we have? We could look at the interest rate environment today, and instead of like annuitizing over a lifetime like I just went over with the SPIA rates, what if we just treat an annuitization like a bond? Okay, and we're just like, hey, let's annuitize this thing over a 5-year period. The cash flow will just kind of come out. The insurance carrier is going to bear all the investment risk as far as like the interest rate movements, and we're basically going to have a 4 to 5% bond fund that's paying $55,000 a year, of which only $25,000 is taxable. Well, now we just created a scenario where we're generating the clients $130,000 of income that they need from a cash flow standpoint. We only have $92,500 of taxable income, and then for that $1.25 million non-qualified account, we have $24,000 of 0% capital gains because anything up to that 22% doesn't pay any capital gains tax. So a lot of the dividends and things being spun off by that account aren't going to have capital gains on them at all. So from an aggregate standpoint, we got them all the cash flow we needed. We unwound a solution that was absolutely the right thing at the time that's no longer the right thing for them at this point. We're muting the sequence of returns events for the next 5 years because we're using that annuity and moving it to more of a riskless type of transaction, right, where all of the payments and all of the interest is guaranteed, and it's not a bad scenario. So this is a chart we made a number of years ago, and I think it's one that we can kind of say like, hey, all of these buckets aren't static, right? From the strategy of moving from a lifetime guarantee, the best thing that could happen, like from a lifetime guarantee standpoint, is the market had a sequence of returns risk, but it didn't have that type of event. And so from our standpoint, we're really moving assets in the scenario I just mentioned from the annuity with lifetime guarantee into a conservative allocation, where we're trying to bucket things from market and sequence of returns risk to say, hey, we still want those next 5 years, even at 73, to not really be subject to market movements. Or if the client has generated enough cash flow, then that's when you might consider like the RILA in the middle or something like that, a balanced allocation. Or if they're in an income annuity and never really need the cash flow because they have rental properties or they had a different liquidity event that no longer they need the income annuity, then you can potentially look at more of the growth allocations. So that's kind of the summary of how to evaluate some of the, from a cash flow and from a generational wealth transfer standpoint. Is my biggest thing is like, if you have annuities, you want to spend them. You should be consuming them, okay? Because from a wealth transfer standpoint, they're not really the best for that. The other thing is like, hey, is it good to 1035 and annuitize? It's something that as we're having these conversations more and more, people are like, hey, I can annuitize the contract as it exists today, or I can 1035 and annuitize it somewhere else. What do I do? Okay? It's important to know that actually when you purchase a deferred contract, the annuitization figures within that contract are actually set at the time of issue. Okay? It's not like recalibrated every year. Okay? So if I bought a contract in 2011, the carrier that I bought that product from had to say what interest rate assumption on a worst case scenario I am, what mortality table am I going to be able to annuitize. All of those things were set in a contract when I actually issued the contract. Okay? So you fast forward to today and you're like, hey, we're in a much better interest rate environment. The mortality tables have changed for the better, right? So are these things actually better to annuitize where they're at or to annuitize somewhere else? Well, more often than not, contracts in the mid-2000s, the interest rates are very low. Here's one I just took a screenshot that basically it says it right in the prospectus. I know everybody reads the prospectuses, but you can see it in there. It says, hey, the interest rate applied to this contract, if you go to annuitize the contract, is 3.25%. It's closer to 5% today in annuitization. Additionally, you can see down here, I didn't highlight it, but it says this is using the 2000 mortality table. So like, we got a better mortality table. So no matter what, if you're annuitizing over a lifetime or you're just annuitizing for a fixed period of time, a lot of times today, you can run the annuitization quotes of the existing contract. New contracts are going to be better just based on the interest rate that we've had. Okay? The last thing is hybrid LTC. I know a lot of you guys are going to be like, hey, you can't 1035 from an annuity to a life insurance contract. I know. But in the same way that you can unwind from a tax standpoint and kind of look at the cash flow planning, some people don't need the annuity for cash flow, but as they've transitioned from that retirement ramp up, the red zone, and now into the wealth transfer, some of them are really concerned about this long-term care risk. And so we see a lot of scenarios, especially in the non-qualified annuities, where we're actually using the annuities to fund the hybrid LTC. So you look at a scenario like this, we got a 73-year-old with a $250,000 annuity, $150,000 of basis. You can use that same sort of cash flow, and you can structure it over a 5 or 10-year period, depending on how much gain it is, and you actually account for the tax. So if it's going to generate $55,000 of cash flow, I've got tax on $25,000 of gain, right? So maybe I account for the 12% of taxes, and I have to put aside $3,000. I still have $52,000 of cash flow to go into a solution like this. And these rates have gotten better. If you haven't looked at like the hybrid LTC market recently, all of them are starting to get a bump because the interest rates are coming up, so the benefits are getting better again. And so you can see like, hey, I just converted a not so great wealth transfer vehicle of the annuity into a guaranteed death benefit of after-tax $260,000 if I never used it. So worst case scenario, I'm moving away from something that'll be fully taxable to my heirs to tax-free death benefit. In addition to that, I can see that my first year I have $8,500 of long-term care benefits. At age 85, that'll compound at 3%. I'll have over $12,000 of long-term care benefits. So it's a good plan, right? I have an annuity. I don't need it for the guaranteed lifetime income, or it doesn't make sense anymore. Let me unwind it. Let me unwind it from a tax perspective for generational planning. If I use it, then I have great long-term care protection to protect the rest of my assets. If I never use it, I converted a taxable asset to my heirs to a non-taxable asset in the form of life insurance. So from a hedging strategy, that can work. From a long-term care on the annuity side, we do have more of the accelerated death benefit play. There's obviously no underwriting for these, so this is literally, maybe there's too much gain built up into the contract, so I just want to keep it kind of in an annuity structure instead of unwinding it, but I want to leverage it to have liquidity at the point in time that I actually have a long-term care event. You know, the other frame of reference here is when you're actually in a long-term care facility and you're looking at like itemized deductions around medical expenses. Those long-term care costs are actually going to spike those itemized deductions, and so I can actually get money out of here, and they'll be tax deductible because they'll be in excess of 10% of my AGI from a medical perspective. So some people kind of use that thinking on, hey, since these benefits are taxable, can they be good? In a long-term care scenario, they actually can be good because of the tax deductibility of the cost that they're funding. Okay, so that's another perspective. So the key takeaways of this is we got to look back through the book, right? We put a lot of these solutions in place 10 to 15 years ago, and I loved what Larry talked about earlier. He said, hey, we put everything in there very conservatively into all our plans, and then we monitor super aggressively. And this is part of that monitoring aggressively type of approach, right? Because whenever we run risk plans, it's always like, hey, let's run this thing at like 4 or 5% return with 3% inflation, and like it's super conservative, and it's the right thing to do. And then when things happen, we can show that like, hey, COVID hit, and at the bottom of COVID, we were showing all sorts of like 20% declines in account values, and it wasn't a significant change on the outcome of financial plan. So we model very conservative, and then we are going to monitor them very aggressively. So the key thing is, I'm sure you guys can think through like 5 or 10 clients that have annuities that you placed 10 years ago. And I really encourage you to kind of look at the income rider evaluation, submit a couple cases, let's talk through them, and then for the ones that are going to be in the 50th percentile, it's a great document to basically say, like, this is exactly how it's working, this is how it's going to leverage, and this is how we're going to get into the insurance carrier's pocket, and it's a great deal. For the other ones, we'll have to have an additional conversation to say, what do we do now? How do we consume this thing? How do we gift this thing? Are we going to use it for long-term care? Are we going to use it for survivor planning? Like, we get to have a lot of fun with it, okay? So that's kind of what we've been seeing over the past decade. I think we've hopefully made an output that's very succinct, like it's literally one page, and all we need is a statement for a contract in order to run that income rider evaluation, and I hope you find it helpful. So that, I think, is everything I had planned, and I am ready for questions.